$500 per ounce. That is where silver is headed, and I know how insane that sounds. I know most people watching will think I have lost my mind. I know the mainstream financial media would laugh at this prediction, but by the end of this video, you will not be laughing. You will be scrambling to position yourself before this move completes, because what is setting up in silver right now is unlike anything we have seen in 100 years. Not 40 years, not since 1980, 100 years. Every previous silver cycle, 1980, 2011, 2020, they all had limitations. They all had factors that capped the upside. They all ended before reaching their true potential. This cycle is different, and I am going to show you exactly why. The industrial demand is different. The supply constraints are different. The monetary backdrop is different. The geopolitical situation is different. The paper market structure is different. Every single factor that matters has aligned in a way that has never happened before in the history of silver. This is not hopium. This is not wishful thinking. This is mathematics. This is supply and demand. This is the inevitable outcome of forces that are already in motion and cannot be stopped. $500 silver is not a question of if, it is a question of when, and those who understand what I am about to show you will be positioned for potentially the greatest wealth creation event of their lifetimes. Let me show you the $500 silver setup. Welcome to AG Profit Hub. This channel cuts through the noise to reveal what is really happening in precious metals markets. No mainstream narratives, no hype without substance, just truth backed by data and analysis. Subscribe now and hit that notification bell because missing this information could be the most expensive mistake of your financial life. If this video opens your eyes, smash that like button. Let us get this to everyone who needs to see it. Now let me show you why $500 silver is not fantasy, it is destiny. Before I break down the 5 factors that make this cycle unique, I need to address the elephant in the room. $500 silver sounds crazy. I get it. But let me put this number in perspective. In 1980, silver hit $50 per ounce. That was 45 years ago. If we simply adjusted that $50 for official CPI inflation, silver should be trading at approximately $185 today. But we all know that official CPI dramatically understates real inflation. Using older methodologies that the government abandoned, the inflation-adjusted 1980 high would be over $600 in today's dollars. So $500 silver is not even reaching the inflation-adjusted all-time high. It is actually below where silver was in 1980 in real terms. But let us approach this from another angle, the gold-to-silver ratio. Throughout history, silver and gold have traded at various ratios to each other. The historical average over centuries is approximately 15 to 1, meaning 15 ounces of silver equals 1 ounce of gold. Today, the ratio is approximately 88 to 1, massively elevated by historical standards. If gold reaches $5,000 per ounce, which many analysts consider conservative given monetary expansion, and the ratio simply reverts to its historical average of 15 to 1, silver would be $333 per ounce. If the ratio overshoots to 10 to 1, which has happened during previous silver manias, silver would be $500 per ounce. So $500 silver is simply the math of ratio reversion during a commodity supercycle. But there is a third way to look at this: supply and demand fundamentals. Silver has been in structural deficit for 5 consecutive years. Demand has exceeded supply by hundreds of millions of ounces annually. Above-ground stockpiles have been drawn down dramatically. At some point, the price must rise to a level that either destroys demand or incentivizes massive new supply. Given the inelasticity of both industrial demand and mining supply, that price point could be far higher than most imagine. $500 silver is not a fantasy number I pulled from thin air. It is a mathematical outcome of historical ratios, inflation adjustment, and supply-demand fundamentals. Now let me show you the 5 factors that make this cycle different from all others. Factors that did not exist in 1980. Factors that did not exist in 2011, factors that exist now and are accelerating. The first factor that makes this cycle different is industrial demand, and this is the big one. Pay very close attention. In 1980, when silver hit $50, industrial demand was approximately 300 million ounces per year. The primary uses were photography, electronics, and some medical applications. Today, industrial demand exceeds 650 million ounces per year, more than double the 1980 level, but that is just the beginning. Here is what is driving industrial demand today that did not exist in any previous cycle: solar panels. Silver is irreplaceable in solar panel manufacturing. There is no substitute that provides the same electrical conductivity and efficiency. Every solar panel produced requires silver. In 2020, solar panel demand consumed approximately 100 million ounces of silver. By 2024, that number exceeded 200 million ounces. By 2030, projections suggest 300 to 400 million ounces annually. Just solar alone could consume nearly half of annual mine production, and every government on Earth is pushing solar expansion. The United States, China, China, Europe, India, trillions of dollars are being deployed into solar infrastructure. Every single panel requires silver. Electric vehicles. An average internal combustion vehicle uses approximately 0.5 to 1 ounce of silver. An electric vehicle uses approximately 1.5 to 2 ounces. Some estimates for advanced EVs run as high as 3 ounces. Global EV production is exploding. By 2030, EVs could represent 40% of all vehicles manufactured. The silver demand from this transition is staggering. 5G and telecommunications. The global 5G rollout requires massive amounts of silver. Cell towers, transmitters, receivers, infrastructure. Every piece of 5G technology contains silver. This rollout is happening simultaneously across the entire world. Billions of devices, millions of towers. The silver demand is enormous and growing. Artificial intelligence. Here is the factor that almost nobody is discussing. AI is the most silver-intensive technology ever created. AI data centers require massive electrical infrastructure. Silver is used throughout these facilities, in connections, in switches, in cooling systems, in every component that requires superior electrical conductivity. The AI arms race between the United States and China is driving unprecedented data center construction. Every new AI server, every new data center, every expansion requires silver. Microsoft, Google, Amazon, Meta, they are all building out AI infrastructure at emergency speed. The electricity demands alone are reshaping power grids globally, and silver is embedded in every aspect of this build-out. Medical applications. Silver's antimicrobial properties make it essential in medical devices, wound dressings, and hospital equipment. Post-pandemic healthcare systems globally are investing heavily in infrastructure. Silver demand from medical applications continues to grow. Now here is the critical point. In 1980, industrial demand was a fraction of what it is today. When prices spiked, industrial users could reduce consumption, substitute alternatives, or delay purchases. Today, there is no substitute for silver in most of these applications. You cannot make a solar panel without silver. You cannot build an EV battery management system without silver. You cannot construct AI data centers without silver. Industrial demand is now inelastic. It must consume silver regardless of price. Companies will pay $50 silver. They will pay $100 silver. They will pay $300 silver because they have no choice. This is fundamentally different from every previous cycle. Industrial demand is no longer optional. It is mandatory, and it is growing exponentially. The second factor that makes this cycle different is supply, or more accurately, the lack of it. Let me show you why silver supply cannot meet demand at any price. Global silver mine production peaked around 900 million ounces in 2016. Since then, it has declined to approximately 820 million ounces. Despite higher prices, despite increased demand, production is falling. This is not because miners do not want to produce more, it is because they cannot. Here is the problem. 70% of silver production comes as a byproduct of other mining operations. Primarily copper, lead, zinc, and gold mining. Silver is not the primary product, it is a secondary benefit. This means silver production is not responsive to silver prices. If copper prices are low, copper mines reduce production, and silver supply falls regardless of silver prices. If lead mines close, silver supply falls. The only way to dramatically increase silver supply is to increase base metal mining by massive amounts. That is not happening. In fact, the opposite is occurring. Mining companies have underinvested in exploration and development for over a decade. Regulatory burdens have increased, environmental restrictions have tightened, permitting timelines have extended. From discovery to production for a new mine now takes 15 to 20 years on average. Even if silver hit $100 tomorrow, meaningful new supply would not arrive for a decade or more. The primary silver mines, the 30% that mine silver as the main product, are also struggling. Ore grades are declining globally. Miners are digging deeper, processing more rock to extract less silver. Costs are rising, margins are tightening. Many primary silver mines are barely profitable at current prices. Some are operating at losses, hoping for higher prices to justify their existence. Here is the math that should terrify you if you are short silver. Current mine supply is approximately 820 million ounces. Recycling adds perhaps 180 million ounces. Total supply is approximately 1 billion ounces. Current demand is approximately 1.2 billion ounces. Industrial, investment, jewelry, silverware, the deficit is 200 million ounces per year and growing. Where does that 200 million ounces come from? Above ground stockpiles, vaults being drained, inventory being depleted. This has been happening for 5 consecutive years. The Silver Institute documents it. The World Silver Survey confirms it. This is not disputed. At some point, the stockpiles run out. At some point, there is no more inventory to draw from. At some point, the deficit becomes a crisis. We are approaching that point rapidly. In previous cycles, supply could respond to higher prices. prices, new mines could be opened, production could be increased, recycling could surge. In this cycle, supply is structurally constrained. New mines take 20 years. Production is declining despite higher prices. Recycling is already near maximum. There is no supply cavalry coming. The deficit will continue. Stockpiles will be depleted, and price will have to rise dramatically to balance the market. This is different from every previous cycle. Supply is broken, and it cannot be fixed. The third factor is the monetary backdrop, and this is where the $500 number starts to look conservative. Let me show you what has happened to money since the last major silver cycle. In 1980, when silver hit $50, total U.S. federal debt was approximately $900 billion, less than $1 trillion. Today, U.S. federal debt exceeds $36 trillion, a 40x increase. In 1980, the Federal Reserve balance sheet was approximately $150 billion. Today, it exceeds $7 trillion, a 47x increase. The money supply has exploded, the purchasing power of the dollar has collapsed, and yet silver is trading near the same nominal price it hit 45 years ago. This is the greatest mispricing in financial history. If silver simply kept pace with monetary expansion since 1980, it would be trading above $2,000 per ounce. I am not making this up. Do the math. 40x expansion in debt, 47x expansion in Fed balance sheet. $50 times 40 equals $2,000. At $35 per ounce, silver is trading at 98% below where monetary expansion suggests it should be. The disconnect is so massive, so extreme, that when it corrects, the move will be violent beyond anything we have seen. But here is what makes this cycle truly different. In 1980, Paul Volcker raised interest rates to 20% to kill inflation and stabilize the dollar. He could do this because debt levels were manageable. The government could afford higher rates. Today, with $36 trillion in debt, the government cannot afford significantly higher rates. Every 1% increase in rates adds $360 billion to annual interest costs. The debt spiral makes aggressive rate hikes mathematically impossible. This means the Fed cannot use the Volcker playbook. They cannot crush inflation by crushing the economy. They are trapped. The only way out is inflation. Devalue the debt through currency depreciation. Let inflation run hot. Nominally grow GDP until debt ratios decline. This is not speculation about what they might do. This is what they are doing. Real rates are negative. The Fed is behind the curve. They are choosing inflation over fiscal crisis. And what is the best protection against currency devaluation? Hard assets, gold, and silver. In previous cycles, central banks had ammunition. They could raise rates. They could tighten policy. They could defend the currency. In this cycle, they are out of ammunition. Rates cannot go high enough to matter. Policy cannot tighten without triggering a debt spiral. The currency will be sacrificed. This is different from every previous cycle. The monetary endgame is visible, and silver is the release valve. Now let me add another layer. De-dollarization is accelerating. BRICS nations are actively reducing dollar dependence. Central banks globally are accumulating gold at record rates. China, Russia, India, they are all preparing for a post-dollar world. The petrodollar system that has supported dollar hegemony for 50 years is cracking. Saudi Arabia is accepting yuan for oil. Russia demands rubles or gold. The dollar's reserve currency status is being challenged in ways not seen since World War II. When, not if, the dollar loses its reserve currency premium, its purchasing power will collapse further. And silver, priced in collapsing dollars, will soar. This is the monetary setup: $36 trillion in debt. A trapped Federal Reserve, accelerating de-dollarization, and silver priced as if none of this is happening. $500 silver is not aggressive in this context. It might be conservative. The fourth factor is what is happening in the East. And this is the factor that will ultimately break the Western paper manipulation. China understands what is coming. They have been preparing for years. And their accumulation of silver is accelerating dramatically. In the past 5 years, China has imported over 600 million ounces of silver. That is nearly 3/4 of 1 year's global mine production absorbed by a single country. They are not buying for speculation. They are buying for strategic reserves and industrial use, solar manufacturing, electronics production, military applications. China now dominates global solar panel production. Over 80% of the world's solar panels are made in China. Every single panel requires silver. Their industrial demand alone is enormous and growing. But they are also stockpiling strategically. The Chinese government has classified silver as a strategic reserve metal alongside rare earth elements. They restrict exports, they encourage imports, they are building reserves that will never return to the global market. And they are not alone. India imported record amounts of silver in 2024. Indian households are accumulating silver jewelry and coins at unprecedented rates. Cultural demand combines with investment demand to create a massive silver sink. Russia has been accumulating precious metals as part of their de-dollarization strategy. Middle Eastern sovereign wealth funds are diversifying into physical gold and silver. Central banks that never held silver are beginning to add it to reserves. The entire non-Western world is accumulating physical metal. They are not trading paper contracts on COMEX. They are taking delivery. They are draining vaults. They are removing silver from the Western financial system permanently. Here's why this matters for the $500 setup. In previous cycles, the West controlled the price through paper trading. They could sell unlimited paper to suppress prices. As long as the East was willing to accept paper promises, the game could continue. That era is ending. The East no longer trusts Western paper. They do not want futures contracts. They do not want ETF shares. They do not want unallocated accounts. They want metal, physical, in their possession, in their vaults, under their control. This changes everything. When the marginal buyer demands physical delivery, paper manipulation breaks. You cannot deliver paper to someone who demands metal. You cannot create silver that does not exist. The Eastern accumulation is calling the bluff of the Western paper market. Every ounce that leaves London and New York for Shanghai and Mumbai is an ounce that can never be used for paper settlement again. At some point, the physical simply runs out. At some point, the paper market loses all credibility. At some point, price discovery moves from Western paper exchanges to Eastern physical markets. When that happens, the paper price becomes irrelevant. The physical price becomes the only price, and the physical price, set by actual supply and demand, will be dramatically higher than anything the paper market has shown. This is different from every previous cycle. The East is no longer a passive participant. They are actively dismantling Western price suppression by draining physical supply. $500 silver is what happens when Eastern physical demand overwhelms Western paper supply. The fifth factor is the paper market itself, and this is the catalyst that will ignite the move to $500. I have covered paper versus physical extensively in previous videos, but let me summarize why the paper market is reaching its breaking point. COMEX trades approximately 800 million to 1 billion ounces of silver daily. Annual mine production is 820 million ounces. They trade the entire annual supply in a single day. Against this trading volume, COMEX holds approximately 280 million ounces in vaults. Of that, only 30 million ounces are registered and available for delivery, 30 million deliverable ounces against daily trading of 800 million ounces. The paper-to-physical ratio is approaching 100 to 1. For every ounce of deliverable silver, there are 100 paper claims. This is not a market, this is a fraud, and frauds eventually collapse. Here is what is different about this cycle. In previous cycles, there was more physical buffer. Inventories were higher. The ratio was maybe 20 to 1 or 30 to 1. There was slack in the system. Today, the slack is gone. Registered silver has collapsed from over 150 million ounces to 30 million ounces. The buffer has been depleted. The system is running on fumes. Simultaneously, physical premiums are exploding. The disconnect between paper and physical prices has widened to historically unprecedented levels. In some markets, physical trades at 70% to 100% above paper spot price. This spread is the market telling you that paper is mispriced. Physical buyers are willing to pay double the paper price to secure actual metal. That is not a functioning market. That is a market on the verge of bifurcation. Lease rates are spiking. The cost to borrow physical silver has exploded from near zero to 5%, 8%, even higher. This indicates acute physical tightness. When borrowing silver costs more than borrowing money, something is very wrong. Delivery failures are increasing. Dealers report extended wait times. Mints implement allocation systems. Some products are simply unavailable at any price. All of these are symptoms of a system breaking. In previous cycles, the paper market could absorb stress. There was enough physical cushion to meet delivery demands. There was enough inventory to support the paper trading. In this cycle, the cushion is gone. The inventory is depleted. The next delivery demand spike will find empty vaults. And when that happens, the paper price becomes meaningless. The physical price becomes the only price. And the physical price will be set by supply and demand, not by paper manipulation. The paper market breaking is the catalyst. The other four factors are the fuel. When the catalyst ignites the fuel, silver goes vertical. $500 silver is what happens when a manipulated market meets physical reality. Now let me tell you exactly what this means for you and how to position for the $500 setup. First, understand that timing the exact move is impossible. What is possible is being positioned before it happens. The 5 factors I described are not predictions. They are realities already in motion. Industrial demand is already surging. Supply is already constrained. Monetary madness is already occurring. Eastern accumulation is already draining vaults. The paper market is already cracking. The question is not whether these factors will drive silver higher. The question is when the price will reflect these realities, and by the time it does, it will be too late to position. Second, physical silver is the only way to fully capture this move. Paper silver, ETFs, futures, these are claims on a system that is breaking. When the break occurs, paper will be cash settled at paper prices. You will not receive metal. You will not capture the physical premium. Physical silver in your possession has no counterparty risk. No exchange can default on you. No bank bank can settle your claim in worthless paper. When silver goes to $500, your physical metal will be worth $500 per ounce. Your SLV shares might be settled at $100 if the fund cannot source physical. The difference could be 5x. That is life-changing money left on the table. Third, premiums are irrelevant in the context of a 10x move. People complain about 50% premiums. I understand. Nobody likes paying $50 for $33 spot silver, but consider the math. If you pay $50 today, including premium, and silver goes to $500, your return is 900%. If you waited for lower premiums and missed the move, your return is zero. Premiums are the cost of certainty, the cost of owning real metal in a world of paper promises. In the context of the $500 setup, premiums are rounding errors. Fourth, dollar cost averaging beats timing. You do not need to buy everything today. Accumulate consistently. Buy every month, buy every paycheck, build your position over time. The move to $500 will not happen overnight. It will happen over years. You have time to accumulate, but that time is not infinite. The system is cracking now. The factors are aligned now. Start accumulating if you have not already. Increase your accumulation if you have. Fifth, think in terms of ounces, not dollars. The goal is not to have $50,000 worth of silver. The goal is to have 1,000 ounces. Or 5,000 ounces, or whatever amount you can accumulate. When the dollar is collapsing, thinking in dollar terms is meaningless. Think in ounces. Count your metal. That is your real wealth. At $500 silver, 1,000 ounces is $500,000. 5,000 ounces is $2.5 million. The ounces you accumulate today at $35 to $50 will be worth $500 each when this cycle completes. This is the opportunity. This is the setup. This is why this cycle is different from all others. There are three types of people watching this video. The first type thinks I am crazy. $500 silver is impossible. Markets are efficient. Manipulation does not exist. They will dismiss everything I have said and continue trusting the system. In 5 years, they will wish they had listened. The second type is intrigued but paralyzed. They see the logic, they understand the factors, but $500 seems too good to be true. They will wait for more confirmation. They will research more. They will procrastinate. By the time they act, silver will be $100 and they will be buying the breakout instead of the setup. The third type understands. They see the 5 factors aligning. They recognize this cycle is different. They are taking action now while silver is still affordable. They are accumulating physical. They are positioning for the move. In 5 years, they will have achieved financial freedom. Which type are you? Let me summarize the $500 silver setup. Factor 1. Industrial demand is revolutionary. Solar, EVs, AI, 5G. Demand that did not exist in any previous cycle. Demand that is inelastic and growing exponentially. Factor 2. Supply is structurally broken, mining constrained, deficits persistent, no new supply coming for a decade or more. Factor 3, monetary madness guarantees currency devaluation, 36 trillion in debt, a trapped Fed, de-dollarization accelerating. Factor 4, Eastern accumulation is draining Western vaults, China, India, Russia all taking physical delivery, paper manipulation losing its foundation. Factor 5, the paper market is breaking, 100-to-1 paper to physical ratios, collapsing inventories, exploding premiums, spiking lease rates. These 5 factors have never aligned simultaneously in the history of silver. Not in 1980, not in 2011, not ever. This cycle is different because every factor that matters is pointing in the same direction at the same time with unprecedented intensity. $500 silver is not a fantasy. It is the mathematical outcome of these forces. And those who position now, while silver is still $35, will be rewarded beyond their expectations. The setup is complete. The factors are aligned. The only variable is time. This is AG Profit Hub. If this video showed you something you did not see before, subscribe and hit that notification bell. I will continue tracking these factors as the $500 setup plays out. Drop a comment telling me what factor you think is most important. I read every single comment. Share this video with anyone who thinks $500 silver is impossible. Show them the math, show them the factors, let them decide. Remember what I showed you today. This cycle is different. The factors are aligned. The setup is complete. $500 silver is not a question of if, it is a question of when. Make sure you are positioned before the answer arrives. I will see you in the next video.